Hello, everyone. It's Dan Kelly. I'm the president of the Canadian Federation of Independent Business. Thank you so much for joining us today. This is a really important time for small and medium-sized firms in Canada. I can't tell you how many battles are brewing right now federally and provincially, and one of the biggest ones is over some federal tax changes that have been proposed by government back in July. These are winding their way through the system. But we thought it was a great opportunity for us to connect with you to share a little bit more about what the concerns are, and also to talk to you about what you as individual business owners may be able to do about that. To help us better understand these changes, CFIB has relied on a variety of tax experts to ensure that we at the Federation fully comprehend the magnitude of the changes. One of the tax experts on whom we've relied heavily over the last little while is Evelyn. I got a chance to know Evelyn back when I was based in Winnipeg. Evelyn, for those that don't know her, is the founder and president of the Knowledge Bureau, which is one of the leading post-secondary education institutes, and she focuses on professional development in the tax and financial services sector. I've had a chance to speak to some of the conferences that Evelyn runs for the advisor community, and I have to tell you, of all the many conferences that I go to, hers are absolutely top-notch, one of the best I've ever been to. She's played an incredibly big role in tax and financial literacy issues over her years. She was appointed by the previous finance minister to the federal tax force on financial literacy. Provincially in Manitoba, she was appointed to the Lower Tax Commission that made a variety of recommendations. And she recently co-founded the Manitoba Financial Literacy Forum in partnership with the Manitoba Securities Commission. She's written 52 books for consumers on tax and wealth management. Many of them have been bestsellers. Her newest one is Family Tax Essentials: How to Build a Wealth Purpose with a Tax Strategy. And she's been widely recognized by business schools and a plethora of international awards. So if there is anybody that can help us dissect these complicated changes and help business owners across Canada understand them better, it's Evelyn Jacks. And Evelyn, I'll turn things over to you to share with CFIB members and other business owners gathered on the phone. I think we have between 800 and 1,000 businesses on this call. So over to you, Evelyn.
Well, thank you very much, Dan. It certainly is a pleasure to have the opportunity, first of all, to work with you, and more importantly, I hate to say, but thank you so much for the opportunity to speak to all of the members. And we really are excited to have the opportunity to share knowledge with regard to what is quite a significant proposed tax reform. And so I'm going to get right into the slides that I have prepared, and hopefully it will enlighten the members a little bit about what we're facing in terms of these proposals and why consultations between now and October 2nd are so important. So I'm going to move the screen forward, and unfortunately I'm having trouble doing that right now. There we go. So what I'd like to talk about is, first of all, what the reforms are, and in the context of where the wealth of Canadians lies, and what the tax risk around those accumulated assets are. And then I'm going to move into an explanation about what the reforms are and what you really need to know as a business owner about the next steps that are being contemplated. And certainly, these reforms have had a lot of controversy, and I chuckled when I saw this little cartoon in the Winnipeg Free Press early this week, because certainly the messaging has been perhaps a little bit awkward, not the least reason of which is that it was released on July 18th of 2017 in midsummer. And it's taken a while for people to really understand the magnitude of what is being proposed. And so it really is important that people do understand it. So where does the wealth lie? Well, first of all, it's important to understand that since 1999, Canadians have actually done very, very well. And that's despite the fact that we've had probably one of the deepest, most significant financial crises in the history of modern times. Despite that, where we sit at the last financial security survey, which was released in June of 2017, is that we have significant growth of wealth in three categories of assets. First of all, it's in mutual funds, investment funds, and income trusts. The second biggest category is in the value of business equity. And in the third, it's in the value of stocks. So this is all accumulated wealth that the government is really taking stock of as we look to financing these services that Canadians want over the next several years. And what's at stake in these particular reforms is that the amount of taxable passive investment income earned by private corporations has actually increased quite significantly, as you can see on the screen, from $8.6 billion in 2002 to about $27 billion in 2015. And the taxman wants a bigger piece of that pie and sooner. And so what these proposals have talked about is that the government wants to raise about $250 million annually, which seems like a low figure. And so we want to look at this a little bit more closely in the context of what's being proposed. Now, this all started in the March 22nd, 2017 federal budget, when the document said that tax planning with private corporations results in high-income individuals gaining unfair tax advantages. A variety of tax deduction strategies are available to them that are not available to other Canadians. And this already was quite aggressive language. And so now, in the promised consultations, we've had a chance to take apart what the definitions of this language, how they present themselves. And it's interesting because this language has defined who the government classifies as high income or rich. And what they've said is that those people who have annual savings beyond the limits of tax-assisted vehicles such as RSPs and TFSAs are people who they consider to be rich, people with more discretionary income over a certain standard of living. And basically what they said is if your income is over that, you should be subject to higher taxation. You've heard the finance minister talk about income over and under $150,000 and whether or not you need to worry about being the target of some of these reforms. And people have wondered, how has he gotten to that number? Well, $150,000 happens to be the amount of earned income that you need to make in 2017 to maximize your contributions to an RSP, plus your TFSA contribution. The government also has defined what those intended advantages that high-income people who have private corporations seem to have. And that's primarily in three areas: income splitting, the removal of cash out of a corporation by way of dividends or capital gains, and the ability to invest with lower tax dollars to earn passive income. Now, unfortunately, what we found is after the proposals, especially in the case of family businesses, unrelated people investing passively through assets held in both public or private corporations will pay a lot less tax than people within the family who are invested in a private corporation will. And that, of course, is very concerning. So that leads us back to what the principles of the Canadian tax system are. And I think it's really important for people to understand this, that Canadians are entitled to arrange their affairs within the framework of the law to pay the least amount of taxes legally possible. And that's a principle that was embodied both in Canada and the United States and elsewhere in the world. Here's a quote from Lord Tomlin, who mentioned in 1936 that if the taxpayer succeeds in ordering his or her affairs to pay the least possible, he cannot be compelled to pay an increased tax, no matter how unappreciative the tax department is. And I got a chuckle out of that quote because exercising your rights within legitimate tax planning tools available today cannot make you a tax cheat in the future. And that's important because if you're arranging your affairs within the framework of the current law to pay the least amount of taxes possible, that's perfectly okay. Tax evasion, on the other hand, is not. The reality for governments is that the personal tax base has been shifting away to the corporate base for a variety of reasons, and the preamble to the proposals goes into this in some depth. First of all, we are looking at a new service economy as opposed to a goods and trade economy as in prior years. We're looking at a shift in demographics. There are a few people earning employment income, more people earning different types of income. We're looking at strong growth in construction, where people who are working are typically hired as incorporated consultants. But of course, we're also looking at the fact that governments have raised personal tax rates, and to some degree to prohibitive levels, in that for some people, the amount of tax they pay at the highest brackets are now over 50%. The number of private corporations, in fact, for all of these reasons, seems to have risen from 1.2 million in 2001 to almost 2 million in 2014. And here's a look at some of those tax rates. Now you'll notice on the personal side, personal income taxes, they're subject to progressivity. And what that means is the more you earn, the more you pay. A couple of years ago, starting with the 2016 tax year, there was a new tax bracket introduced, and that was for people whose incomes exceeded $202,800 in 2017. That's an indexing factor from the original $200,000 when it was introduced. Those people federally are going to pay 33% on income over those amounts. You'll notice progressivity means that if you're in a middle income bracket, and I'll point out between about $46,000 and $92,000, you'll pay about 20.5%. Notably in that tax bracket, there was a reduction when the current government came to power of 1.5%. But that's not all. Because remember that the federal government is only one level of government to which you pay personal income taxes. When we add in the provincial taxes that you also pay, and your province of residence is determined by where you live on December 31st of the tax year, you'll see that if your income is over $150,000, and that's that magic number that our finance minister has been talking about, then in Ontario, your ordinary income is going to be taxed at 48%, in Alberta at 42%, and in BC at about 43.7%. Your capital gains are half of that, and your dividends coming out of your small business are sort of hovering somewhere between 33 and 39%, depending on where you live. Your income from public or large corporations is somewhat less than that. But if your income is over the $202,000 mark, you will see that that's where certain high-income surtaxes are going to start kicking in. And in Ontario, we're paying well over 53%. On our ordinary income, which includes employment and pension income. And you can see that the taxation of small business dividends has been rising recently, and it's very close to 50%. eligible dividends from large and public corporations is coming in just under that, but nonetheless in Ontario, for example, still at around 39%. And so the conversation has really gone towards the fact that different sources of income are taxed differently because we take on different kinds of risk. For example, in CRA's own bulletin on the difference between an employed and a self-employed person, the self-employed person is going to take on the following risk factors: the responsibility for the investment in the enterprise itself and the management of those resources. They have control of the assets and the acquisition and purchase of those assets, the hiring and firing, and the control of how people do their work. They actually have the financial risk. Employees still get paid even though the supplier or the company doesn't, because perhaps the quality isn't there or they didn't meet their deadlines. And of course, who has control over both revenues and expenses and the realization of profits? That's going to be the person who is self-employed, or in the case of private corporations, the shareholder. Also, and very importantly, the person who pays the source deductions is going to be the owner of that enterprise. And that can get you into a lot of trouble with the tax department if you don't do it well or on time. In fact, the person who owns the business bears the risk for audit. And this is an important concept. The burden of proof is on the business owner to show that CRA audits are wrong. And that becomes a very important part of what's to come in my explanation, that there have been new concepts introduced again in the proposals that are going to increase the audit risk for business owners. Remember also that business owners must collect and remit a variety of taxes, and by the way, that's unpaid tax collection, whether it's payroll tax, GST, corporate tax installments, or individual tax. The burden of proof and the burden for remitting on time is there, and if it's not done, it's subject to quite punitive penalty provisions. Another important concept is that there should be no double taxation on a single source of income. And for those reasons, we have what's known as an integration theory between the taxes that are paid in the corporation and what happens when the income comes out of the corporation flows through into personal hands. And remember that there has to be a tax when that money flows through from the corporation to the individuals. And basically there's only one exception to that, and that is when you're flowing through exempt amounts like the 50% of capital gains that are not taxable, or life insurance benefits that are earned within the corporation. And so the way we integrate the personal and corporate tax system to ensure that there's no double taxation is that on the personal side, we gross up the dividends that are received out of a corporation, and we apply a dividend tax credit. And on the corporate side, we do pay top marginal tax rates on passively earned income. But when it's flowed through the individual, that corporation gets a refundable dividend tax on hand out of the RDTOH account, a notional account that's set up. And also they're able to flow through out of the CDA account any tax-exempt portion of their capital gains or their life insurance policy proceeds, as an example. Now, what's being contemplated is that those two accounts, the RDTOH and the CDA account, are going to be potentially eliminated. And that has an implication around tax neutrality. Business income, of course, should always be measured by a common standard. And the question really is, at what level should the discretionary income that people earn above a reasonable standard of living be taxed? Capital also is being invested to gain an economic reward in the future, should that economic reward be taxed at top marginal rates. These are all the issues before us. So currently, is it better for us to earn investment income inside or outside of a corporation? Well, as things stand today, we find that for incomes that are over $220,000, that it is somewhat better for us to actually earn the income outside of the corporation as opposed to inside of the corporation. That's going to depend on where you live, of course, but if we take a look at Ontario and Manitoba, we see that it is significantly better to earn outside of the corporation, especially when it comes to corporate investment income. So what's changing? What's changing is all passive income earned inside a corporation is going to be taxed an amount equivalent to the marginal tax rates. But if it is going to be flowed through, it will be flowed through as a non-eligible dividend, no matter where it's earned, within the private corporation or the public corporation. And it's going to include both capital gains and portfolio dividends. What that means is when we integrate the personal and the corporate tax system, what we're seeing is effective tax rates of about 73%. My example on this screen is for Manitoba rates. What the government says is that taxpayers should be incented to flow through any income from their small business corporation in order to get the progressive tax rates that I showed you earlier. And the Finance Department says that these new rules should have limited impact on existing passive investments. But of course, the controversy is, are they right? What we're seeing over time, and I'd like to thank Larry Frostiak of Frostiak and Leslie here in Winnipeg for doing these calculations, that when we take a look over a 20-year hold period at the difference between what an employee at a top rate tax bracket and a private enterprise owner will pay as a result of these changes on their passive investment earnings, you'll see that quite significantly the private owner is going to pay more. And the devil, of course, is in the details. What we're seeing is that progressivity is gone, as I've mentioned, and more importantly, the government is attempting to remove any discretion you may have to distribute dividends or retain income by incenting you to do so in your personal hands as opposed to leaving the money in the corporation. And that's where this concept of tax neutrality may in fact not be met in these proposals. And it's important to look back at what previous tax reforms have said about the existing structure of our personal corporate tax system. We had a wonderful passage extracted from Edgar J. Benson's proposals in the 1972 tax reforms. This is thanks to Dean Smith of Cadesky Tax. And basically, what the finance minister of the day said is that it's clear that not all tax savings within a corporation will be used immediately to expand business operations. If a corporation does not wish to expand its business in the year in which a small business incentive is earned, it can invest in short-term debt securities or pay dividends to its shareholders. The dividends will, of course, be taxable in the shareholders' hands and at the marginal tax rate of the recipient. If the corporation allows the tax savings that result from the low rate for non-business purposes, such as portfolio investments, a special refundable tax will be imposed to recover the low rate benefit. So prior to this tax reform, what we had was a graduated tax rate system. today we're proposing that we're going to close up some of the ability for people to choose where they invest their retained earnings, and we're going to not go back to a graduated tax system. And so there's lots of questions. First of all, with your passive investments, we are not sure from what we're reading in the proposals whether the capital dividend account, which houses the proceeds of life insurance policies, is going to require those benefits to be paid out on a taxable basis or not. And that's an important question at this time. We also see that any losses that are earned by the corporation, currently, of course, we can't generate those losses through into our personal hands. They stay within the corporation. It would only make sense that the government revisit that particular structure if indeed the proposals that they're considering are going to go forward. It's something that we're not seeing in those proposals at the present time. The government has said with regard to their proposals with regard to tax on passive investment earnings, that this will be done on a go-forward basis. In other words, that assets that exist in the corporation today may not be subject to these reforms. And yet, there's still a question mark around what the future taxation is going to be on accumulating assets. And in particular, what the impact of these changes is going to be on business succession in the family, or indeed on funding the buyouts of shares on death. I'd like to move now to what's being proposed with regard to income splitting with family members. There's a couple of new definitions in the proposals that you and your tax advisors might want to get your heads around. First of all, there's the definition of a specified individual. And largely that refers to that person who today is under the age of 18, resident with their parent in Canada, and subject to what we know as the kiddie tax. In other words, if they receive distributions, certain distributions from the family business, those distributions are going to be separated out on the personal tax return and taxed at top marginal rates. Now, after the reforms, this kiddie tax is going to be actually extended to any Canadian individual, regardless of age, who receives split income. Dividends received are going to be taxed at top marginal rates, and exempt from these rules will be reasonable salary or wages taxed at individual marginal rates. Now, that person is going to be linked to the person who is a connected individual, the person who has strategic influence, an equity influence, earnings influence, or investment influence. And I've given you some details around that in this slide that you can look at later. The definition of split income now is going to include income from debt obligations and also certain gains from dispositions after 2017. And any property that's subject to the tax on split income rules as they're newly defined, or the attribution rules. There is going to be tax levied at the top marginal rate. But of course, we're still going to have to take the split income into account for certain income tested tax credits. Now let's take a look at how this is going to be expanded in terms of the new definitions. The person who receives split income is going to have their contributions linked to both their labor and their capital. So if they're over the age of 25, the government is going to look at what their labor contribution is. Are they involved in the daily activities of the business? And are they remunerated through salary or wages? Another test is whether or not they've contributed capital and assumed risks to support the business. So those are the criteria for somebody over the age of 25. But the test is much more onerous for someone between the ages of 18 to 25. The labor test is that that person must be actively engaged on a regular, continuous, and substantial basis in the activities of the business. Otherwise, income is going to be taxed at top rates, but this is not true of someone you might hire who's unrelated to you. So in other words, if you hire your son or daughter who is age 23, they're going to pay tax for working in the business at top marginal rates, whereas your neighbor's son or daughter will pay tax at graduated rates. In addition, when we look at the capital tax, the allowable return of the assets contributed by someone between the ages of 18 and 25 must not exceed the prescribed rate of interest, which is currently 1%. So they're not allowed to earn more than that on the capital contributed. But the allowable return on assets contributed by an unrelated person in this age category would not be so restricted. You can imagine that there are a number of gender and family issues that are going to result from these reasonableness tests. When we look at the gender lens that is being talked about in these proposals, we find that males represent 70% of the high income earners who initiate income splitting strategies that are targeted in these reforms, and they also represent 74% of the people who receive net gains from dispositions of small business corporations, and 66% of non-eligible dividends received by shareholders, and those are all 2014 figures. Now, families by default may have a lot to lose because with the higher taxation and the higher business purpose and contribution tests, there's going to be some slack that has to be made up, possibly by other family members who may have to work longer hours, or by families that have to do without. The family income splitting rule changes definitely provide some obstacles with regard to wage reductions in the open market as well. I'm going to give you some stats around that in a moment, but what I want to remind you is that reasonableness testing is now being reintroduced, and that's problematic. It was problematic back in the 90s when we were constantly seeing court cases against a reasonable expectation of profit test. And again, the courts ruled that this became a tool used by CRA to second-guess legitimate business purposes in a vague and arbitrary manner, and that in itself resulted in some unfair tax treatment. And a notable case on this was in the Supreme Court, Stewart versus the Queen. These current proposals have the effect of bringing us to the same place again. They're subjective and they're really not auditable. This was pointed out in a recent editorial by Peter Weissman from Kadesky Tax. The burden of proof here is on the taxpayer, who is left at the mercy of the CRA and litigators who will have a field day with this going forward, he said. The reforms instead should strive for impartial, clear, and auditable solutions. Now moving to the capital gains exemption, there are some significant changes being proposed here, including an election to crystallize values established at a point in time in 2018, which could in fact, first of all, take you on a journey into valuation exercises. It could generate an alternative minimum tax liability for you and your family members, and that liability will have to be covered by you. Gains reported by minors, employees in an employee profit sharing plan, gains accrued before the end of the year in which a person turns 17, gains included in the new definition of split income, and gains in a trust set up by family members are all going to be examples of ineligible gains going forward. There are some exceptions for qualifying beneficiaries with regard to the lifetime capital gains exemption. And this is going to take us down a road in which there's going to be a lot of activity on crystallizations between now and the end of the year, particularly as it relates to structures that include family trusts. And certain eligibility periods are going to have to be met. for 12 months instead of 24 months, say the proposals in terms of purification. Nonetheless, this is important for you to discuss with your tax accountants immediately, because we have seen draft legislation in these proposals that could immediately turn into a bill, both for the capital gains exemption and the family income splitting rules. And so this is of immediate concern. There are other changes proposed for the stripping of surplus out of a Canadian-controlled private corporation. And these changes certainly are of concern because they will now make it more advantageous to sell to non-arm's length third party. And this has implications for succession planning from one generation to the next. And so we're left with a lot of questions on these proposals. Why is there a triple tax of capital gains on the death of a business owner, for example? First on the individual return, then on the sale of the assets within the company, and on distribution of the dividends to the survivors. Why is there double tax on dividends from publicly traded companies? And how will future taxes on assets accumulating in the corporation actually be taxed? Some of this might be better accomplished with a simple surtax if we are concerned with very high income earners who are getting too much of an advantage within their passive investments. And don't forget, alongside all of this, there are other changes going on. Work in progress, rules have changed. The Canada Pension Plan benefits are going to start to increase starting in 2019. And of course, we've seen a small increase in EI benefits as well. There's a lot to think about in this very significant reform. Should we be taxing individuals or families? At what tax rate should we think about levying? What tax should be levied on discretionary income inside and outside of a corporation? And should there ever be double taxation on the same source? Should income source and timing be taken into account as in particular as it relates to an investment in any asset? And should income averaging be brought back? It's a provision we had in our past. Should we ever be taxing blips, one-time good luck or good opportunities, whether inside or outside a corporation? Remember that when we increase corporate income taxes, and governments like to want to do that, but empirical evidence suggests that it does fall on workers eventually. A recent study by the School of Public Policy in Calgary tells us that for every $1 increase in corporate income taxes, wages fall by $1.52 in Alberta and up to $3.85 in Prince Edward Island. And so even though we're seeing some legislation to shore up minimum taxes, we really want to ask whether we want this to happen, particularly in higher wage scenarios. So you do need to talk to your tax advisors now about whether or not you should be sprinkling dividends out to your family members before the end of the year or crystallizing your capital gains. Or should you leave your money in your corporation between now and the end of the year and ride it out? Certainly, this is one very compelling reason for us to extend the consultation period so that people have time to arrange their affairs within the framework of the law, not to do the wrong things at just the wrong time. And it's interesting that all this is happening around a time when we're celebrating a very important 100th year birthday, and that's the introduction of the personal income taxes back in 1917 to begin with. So remember to light a candle. So in summary, lots and lots to think about. I really hope that you will take this message to your MPs, to your tax accountants, because a lot of money is at stake. And I hope that also that our MPs will allow us the time to think about a modern tax reform for the economic and global changes that are going on around us. But really, at the end of the day, your voice matters. This was simply, from an educational point of view, not a matter of opinion, but hopefully a matter of enlightenment. And so we invite you to learn more. We are very pleased that we've had this opportunity to share knowledge with you. And Dan, with that, I'd like to pass it back to you.
Thank you so much, Evelyn. That was just terrific. I'm sure you can all see why I am such a fan of Evelyn's work. She has provided incredible advice to people in positions of public policy for many, many years, and we at CFIB are grateful to you and the work that the Knowledge Bureau does. Picking up the mantle from there, if you weren't depressed before this call started, I'm certain you are now after hearing the fairly sobering expectation of what's to come. I should mention right now that, and I should have mentioned at the beginning, I'm afraid, but there is on your control panel, there's a comment box, and I'm going to try to whip through my part of the presentation fairly quick to allow a few minutes for questions for Evelyn and I to answer any questions. You can direct them at either of us or to both of us, and we'll do our best to answer a few in the last few minutes. From CFIB's perspective, of course, many of you are members of CFIB, or you are business owners that are looking at what we're doing at the Federation. I have to tell you, I've been working for the Federation for 23 years, a lot of it dedicated to tax policy, and I'm not sure that I ever have felt a time when business owners were so mad at their government. They're not mad just because of the changes that are being proposed. In fact, I'd say most business owners are unaware of the freight train that's coming at them. But they're angry also, not just at the policy, but also the way that the policy has been communicated, the rhetoric that government is using, almost leaving it out there to other citizens that small business owners in large measure are tax cheats. And this is a very disturbing thing that we're hearing from our government right now. We at CFIB believe that the role of the entrepreneur should be celebrated, that we just don't do enough as Canadians to recognize the massive contributions that independent businesses bring to our economy, to our country, to our economy, and for employees. And so it's really disappointing to hear the language that is being used. I think the government's getting a little bit more sensitive about it in the last few days, and that's a good thing. But still, these changes have found, I think, a business community that is questioning where government wants to take things. Evelyn focused on what the tax changes are, the three big buckets: sharing income among family members, holding passive investments, and then taking some of the income through capital gains. I thought it wouldn't be a bad idea to remind everybody, though, why we have a lower rate of taxation on small business in the first place. There are some good and valid reasons for that. One is that when you look at the overall burden of taxation, all forms of taxation that small firms face, the effective burden of taxation, and research has borne this out, is higher than it is for other taxpayers, either large corporations or individuals. Secondly, small firms endure a higher cost of tax compliance. They have to basically follow the same rules and implement all the same measures that a big company would, but on a much smaller base, without all of the staff and other resources that a large firm might have at its disposal. And that's another reason why small firms have a lower rate of taxation, is to reflect that. And third, and I'd say most importantly, is that the lower rate of taxation on small business helps to address the more limited access to financing that small firms have. We have complained for years that banks are not willing to take particularly big risks on some smaller firms. Even when those small firms are not particularly risky, they often struggle to get financing. And the lower rate of taxation allows businesses to reinvest the savings into growing their business, which conceivably would be the way to help grow our economy and help employees more when small firms do that. So we're really afraid that these tax changes are going to make it more difficult to share income among family members, more difficult for business owners to save for their own retirements, but also for the business itself, not just for the income of the business owner. We worry that this is going to have negative consequences on them. It'll inhibit businesses from taking on more risk or making further investments. Also ensuring that they have stability in leaner economic times. And all business owners have gone through periods, either themselves or for the economy more broadly, where they've not had the customers and the demand that they've needed to keep their firms afloat. And at the very least, what this is likely to do is create a decade of uncertainty, where while these rules wind their way through the CRA and then wind their way through the courts, business owners are going to be left throwing up their hands saying, I just don't know what to do. How am I going to protect myself? And of course, advisors are going to be able to provide some degree of advice, but even they are not going to have perfect information for a while until this is all settled out. We're trying to remind government that small businesses in general are firmly in the middle class. If you look at this is the income distribution of people, of corporations claiming the small business deduction. And as you can see, the vast majority of them are fairly modest levels of income. The minister seems to have started to adopt some of the language we've used, which is that 2/3 of businesses in Canada earn less than $73,000 a year. And he's suggesting that these changes are not going to affect those under $150,000, but we just don't believe that. There is evidence, and Evelyn certainly pointed at some of it, that suggests that all firms, in one fashion or another, are going to be affected by these changes. And getting back to that point that I raised earlier about the fact that that small firms reinvest those, any money that they have back into their business, one of the big things on the government's agenda right now, it certainly was the theme of the 2017 budget, was to stimulate innovation and have firms in Canada spend more money to become innovative and look at different ways of doing things than they had in the past. When we asked CFIB members how they pay for any kind of innovation in their business, what was the number one answer? It was their business's equity, their funds, or their assets that they drew on for those kinds of innovative projects. And beyond that, they take their personal debt or other business debt to help them do that too. And so, the government can't have it both ways. It can't say we want the business community to be more innovative and at the same time serve to dry up some of the very sources that would help them do that. This is one of the cartoons that there have been many that I like the best, and I loved Evelyn's too, but this one obviously showing the noose around the neck of the small business owner with the Prime Minister and Minister of Finance suggesting that it's just about closing loopholes, kind of says it all to me. And this is deeply, in our view, deeply, deeply unfair. This isn't about fairness. This is creating an unfair tax situation for small business owners. And if we were looking at true fairness, maybe the government would like to look, governments of all levels would like to look at a few of these things. The 2-to-1 ratio that employers pay for CPP, where the self-employed have to pay twice, they have to pay both the employer and the employee share of the Canada Pension Plan. How is that fair to business owners? They're only allowed to draw one time the benefit, and yet they have to pay double the amount of everybody else. If the government's keen to compare business owners to employees, maybe that needs to be addressed. Employment insurance. Employers pay 1.4 times the rate that employees do. Not only does the employer not get to draw EI benefits, but they have to pay 60% of the costs and the employees only 40% of the costs of the system. Property taxes, you know that commercial rates are much higher, and even if you're renting your property, you're effectively paying that anyway. But typically, commercial property draws 2 to 5 times the rate of property taxation on the same assessed value than a homeowner does. Workers' compensation, WSIB, benefits to the employee, but 100% of the costs to the employer. Employer health tax in Ontario, payroll taxes, provincial payroll taxes in several provinces, 100% to the employer and 0% to the employee. So we think maybe these kinds of provisions should be looked at from a fairness lens. But what do we want ultimately from government? After listening to Evelyn's presentation, I suspect you're similar to the views that we've been sharing with government, and that is we want them to drop these plans altogether. We don't just want them to delay the consultation period, because we believe these proposals right from the start are incredibly negative with all sorts of very serious negative potential consequences. So we're asking them to drop that. We're not suggesting, though, that there are no problems in the income tax system. We recognize that there are abuses that are out there. There are abuses on the personal income tax side, and there are abuses on the corporate tax side. We're willing to sit down with the government and work through any of the potential soft parts of the Income Tax Act and stiffen it up. But that hasn't been allowed to happen, because the business community's not been given the opportunities to talk to government. They've essentially thrown us legislation saying that this is coming and tell us what you think. That's not the right way to do tax reform. So what are we doing about it? We're asking the business community more broadly to act now, to tell the government that they should not be punishing small firms with these new tax proposals. This is all for those of you at your computer afterwards, you can look at this. CFIB.ca/tax changes will tell you how you can get involved in this campaign. One of the things that we did is started a coalition of business associations, and I know this slide's probably a little hard to read, but these are now a list of 62 different associations that are working together with CFIB to push back against these changes. That's a pretty big deal. It is rare that the business community as a whole comes together the way that it has on this, and I'm sure you can find on this list several of the other associations of which you may be a part. We're asking business owners to sign our petition. We have an online petition at that same website, cfib.ca/tax changes, and we're asking you to sign that so we can relay those responses back to government directly. We also have a survey out right now. This is also on that same website. The survey asks business owners how they're using passive income, asks them what they think of these government changes, and we're going to be releasing that in the days ahead. And then for business owners that want to do more, a few of the ways, and Evelyn hinted at this earlier, is to reach out to your member of parliament. There's still nothing beating going and talking to your member of parliament, either contacting them through email, phoning their office, or dropping into their office, or perhaps on Twitter, reaching out and expressing your concerns about this package of tax proposals. We're also asking members to send us their suggestions, what they think that the impact will be on their firms, to CFIB@cfib.ca, and we'll make sure that we relay that directly to the minister in our submission. And finally, for those that really want to go to the full extent, you can respond directly to the consultation that the federal government has put out. The email address is there, and you can check it out. But a Google search will also bring you to the consultation website. You can see the discussion document that exists. It's also linked from CFIB's website directly. These are some of the important dates. What we're asking business owners to do now is to make some noise and talk to their MPs. This is absolutely critical. That's the phase that we're in right now for the next few weeks. On October 2nd, the official consultation, and I do use the quotes deliberately because it's not much consultation from our perspective, that's going to close off. And then we suspect that any time in the fall, the government could put a Ways and Means motion before the House of Commons. And if they do that, they don't even have to have it pass, but it'll take legal effect, and the CRA will be able to implement those provisions potentially starting as soon as 2018. This could also come through an economic statement that the government might issue in the fall, but we suspect that if this is going to happen, it'll happen before the spring 2018 federal budget at the latest. So that's really the end at which they might implement those changes. So that's a little bit of the milestone. As you can see, there's great urgency for us to make sure that the message is getting out there, sharing this with your fellow business owners, ensuring that they are aware of the freight train that's coming at them, and expressing your views, particularly to members of parliament, can be incredibly effective. We're already sensing that there are Liberal MPs that are getting nervous about these changes. That's a good thing. If the Liberal MPs are getting a bit spooked on this, they'll bring that message to government. But regardless of the party, make sure that you are talking to your member of parliament and expressing how seriously you take these issues. Expressing your views if you happen to support these changes, share that with them too. But really the time for that is now. So with that, I will close things off on the formal side of the equations. We have a few minutes on the equation. We have a few minutes left for some questions, and we will I'll open that up right now. Evelyn, I don't know if you've had a chance while I've been speaking to have a look at any of these potential questions, but
no, not yet, Dan.
Okay. Oops, struggling to expand this here. Hang on. Oh, here we go. Yes. So one of the questions from Linda was: is there a document we can have access to that provides the specifics of the tax proposals? On the CFIB website, there is a link to the federal tax changes. That's the government's take on this. If you follow either Evelyn Jacks on Twitter or me at CFIB on Twitter, we have been retweeting, both of us, many links from tax professionals as to how these changes are likely to take effect. And Evelyn's document, I believe, is available as a takeaway from this that outlines many of the potential impacts. Does government think that a different government might reverse all of these tax changes? Potentially, but once tax policy goes into effect, it is very hard to undo. And our primary focus right now is ensuring that we can convince the current government of the folly of their ways, and at the very least get them to put these proposals on ice, asking them to work with us on shoring up any weak loose ends in the income tax legislation, and not just steamrolling ahead. Evelyn, did you want to take any, or are you able to see them?
I'm not able to see them, unfortunately, but concur with what you just said, Dan. These reforms are much more significant than perhaps has been indicated in the media, and I think it's really important that people, do go and see their tax accountants and advisors and figure out what it means to them.
Terrific. And another question or comment from Nikki, who's an accountant in public practice, who's very angry and disappointed by the proposed changes. You've got that right, Nikki. She says that the proposed changes will, if passed, will severely impact the small businesses who are the backbone of the economy. The majority of the business owners invest every dollar back into the business. Small business owners take on a very large amount of risk and as such should be compensated. The small business owners are the middle class. We implore CFIB to advocate for us and to do their best to convey the anger and frustration and stop the government from passing these laws. Incredibly well said, Nikki. Thank you so much. That's exactly what we're looking to do. These are, essentially what we're trying to ensure is that these changes are dropped altogether. So thank you very much, everyone, for joining us on this call. I really do urge you to take some action coming out of this. Do pay close attention. Twitter has actually turned out to be a great place to read all the regular updates from those that are concerned about this. There is a hashtag that is being used. It's the #, so hashtag unfair tax changes. Use that on Twitter. If you search through that on Twitter, you will find an absolute wealth of information. There have been so many tax professionals that have shared their views on this. And as I pointed out in the media for some time, one of the things that is really heartening is that the business community itself has reacted quite quickly to these changes. I don't think we spend enough time as business owners because business owners are so busy managing the day-to-day operations of their business. They don't have the time to poke their head above water and to say, hey, this isn't fair at all. But on this issue, it seems like that's happening. And I'm so grateful to the business community. I've reminded politicians regularly that while it's very easy for them to sit in their beautiful offices in the House of Commons and suggest that so-and-so is not paying their fair share, a lot of Canadians, and a lot of Canadians do buy into that, sadly, that they don't factor in. They weren't around when the business owner was remortgaging their home to make sure that the business could stay afloat. They weren't there in a bad month where the business owner put the payroll on the credit card to ensure that they could hang on to their employees for whom they hold in great esteem. These are the things that I don't think politicians fully appreciate. And but I can tell you for sure that Evelyn does and we at CFIB do. Very grateful for everybody for the support that you've shown so far, your interest in this campaign, and asking you to ensure that you share the word with other business owners and certainly your political leaders. Thank you so much.